So ever since I became a dad about 3 years ago, there's been one thing I've been obsessing over, which is term insurance. And specifically, how much term insurance do I really need? When I set out to look for an answer to this on the internet, what I found were these thumb rules that, hey, you should have 10x your income or you should have 20x your income as coverage, which I felt was lacking in context and nuance. So for example, it doesn't take into account how much corpus do I already have and how much is that corpus going to grow by? When do I need this money? What about my spouse? What if they are earning and they are saving, right? So all of those nuances were completely missing from this thumb rule of 10x your income, and that's why I set out to build my own calculator. And so if you're curious like me, you will find this video useful. I'm going to share that life insurance calculator. It's going to help you answer two things. One, how much term insurance coverage do you need as things stand for you? And two, how long do you need it for? If you're new to the channel, I'm Pranay. I work at Google myself and I help people like me who are in the workforce make smarter financial decisions. Consider subscribing to the channel if that's something you find useful. Before we proceed, I also want to give a big shout out to Ditto, who's the sponsor of today's video. More on that later.
This channel is brought to you by the 01 Media Network by Zerodha. With their support, I'll be helping you spend your money wisely.
All right, so now let's look at the calculator on the screen here. All of the yellow fields are what you need to be entering and inputting, and then there are two scenarios that will turn up here, scenario 1 and scenario 2, that we'll go into deeper. So before I jump in, let me also show you how to make a copy, because it's not funny the number of people who send me edit requests. Please understand, I cannot give you edit access to this because that edits the entire base sheet, and if you change any formulas or calculations, this is going to mess it up for everybody. So make your own copy and then you can edit that. This is how you make a copy. You go to File, you click on Make a Copy, you click on it. It asks you this, Copy of Life Insurance Calculator. You click on Make a Copy. You can change the name of this. You can call it, say your name is my favorite name, Gaurav, who's a colleague. Gaurav's Life Insurance Calculator. You can just change this and now you can edit whatever you want, right? So that's how this works. Please make your own copy. Do not ask me for edit access. Now let's jump in. Okay, there are multiple sections in this. This is the input sheet where you input all of the stuff and then it will spit out the answers for you. So let's start. Your current age. I just make this up because I'm not going to share my details, of course. But your current age is 30 years. Spouse's current age, I assumed, is 30 years. Age you plan to retire is, say, 45 years. If AI lets us keep our jobs that long. Current annual post-tax income is 25 lakhs. Spouse's current annual post-tax income, let's assume that is also 25 lakhs. You can enter 0 if your spouse is not working. Total household post-tax income therefore comes to about 50 lakhs. Now let's get to the second part, which is your family's current expenses and liabilities. So your family's total annual expense, I've just made these numbers up, is 15 lakh rupees, right? Include all expenses here, including your EMI, school fees, everything, like insurance policies in the course of the year, whatever else that you can think of. If you send money to your parents, include all of that stuff here. Next is outstanding debt. Now this is two items. I've just broken this up. So if you have a home loan, I've assumed you have a home loan of 50 lakh rupees. So you input that here. And you input any other debt that you might have, example, a personal loan, I hope not, but credit card debt or any car loan or whatever else. What is the outstanding amount for that? I've assumed that it to be 5 lakhs. Yeah? And you can enter 0 if you don't have any debt, right? So that's your current expenses and liabilities. Now we get into your current assets. Existing financial corpus, the current value for this in rupees, I've assumed is 30 lakh rupees. So you've been working for a while, you've been disciplined with your savings and you have 30 lakh rupees of corpus. You can also make this 0 again. It doesn't really matter. Your existing term insurance cover, I have assumed is 0 for now, right? You can change this to suit yourself. But for now, I have assumed this 0 and we'll come back to this in the end as a check whether changing this changes the impact or not. So your existing term insurance cover is 0. Your existing term insurance end age, again, you don't have any covers in 0. But say, for example, if you had taken a policy till the age of 65, you add 65 there. Then this is the amount of years that you are covered for.
Now, if all of this is too complex for you and you want a slightly simpler calculator, then you can actually go to the Ditto website. You can go to life insurance and see their term insurance calculator. Here you can enter your age. This is a simpler version of it. The complex calculator that I showed is probably not for everybody. So this, if you say 30 years and you want duration till say 50 years, because that's the assumption we made, your monthly expenses are 1,25,000 because that's what we looked at in our thing, and your outstanding loan is about 50 lakhs, right? Your outstanding loan is 50 lakhs. Then you get to, and if you use this calculator, this is showing you that you need a coverage of about 3.7 crores. It's just coincidental that it is coming to about the similar amount here, which is great. You could basically use this calculator as well and get your job done. So Big thank you to Ditto for sponsoring today's video. Ditto is not just this calculator, they also help you buy term insurance, they help you buy health insurance, they are spam free, they are unbiased. And so this is the term insurance calculator on the Ditto website. You can go check this out as well. Ditto is a platform that I personally use, so I would highly recommend them.
Okay, let's move to the next section, which is future goals and assumptions. So the one I have taken here is the question I've been pondering with. So I'll start with that, but you can make this your own and edit it in whatever shape and form you like. So youngest child's current age, which means 1 year, that you have a child who's 1 year old. You need the money for this child to go to college when they are 18. The money that you need in today's term, the current cost of that college education is, I've taken that to be 1 crore rupees here. You can say it's high or low, you can change it on your own. If you have other financial goals in the future, you can keep adding that here. So if, for example, you have 2 children and you need 2 crore rupees, say 17 years from now or 15 years from now, you can keep changing that stuff here, right? And that'll help you arrive at a ballpark. Next, some assumptions. How much is your corpus going to be growing by? What post-tax returns can you generate? And what are the inflation assumptions? Because those are extremely important when we are looking at it over a long period of time. So let's start with that. First is education expense inflation rate. I've taken that to be same, that hey, and I've taken at an aggressive 8%. That 8% is what your inflation is going to be in your education and in day-to-day living. So 8% to keep it simple. But again, you can change this. Investment growth rate, I have taken a conservative number here of say 10% post-tax. Because we want to be overcovered and not undercovered, and that's why I've taken this to be around 10%. You can increase this, reduce this basis your comfort level and your historical track record of how much are you able to generate. So I've taken that as 10% post-tax return on your investments that you'll be able to generate. Now let's jump in. Annual savings amount. This has been computed. You have your household income of 50 lakhs. Your family's total expenses 15 lakhs, and therefore your annual savings amount is 35 lakhs. Annual savings growth rate, I have assumed that you are going to be increasing your savings over the course of the next few years by 5%. Years you will continue to make these annual savings is again very simple. You want to retire at 45 and you are currently 30. So for the next 15 years, you are going to be continue to adding savings, and that's why it's 15 here, right? Now we move to the last one, which is target age for corpus projection. You can take this. I've taken this. This is a number that you can put in that, hey, you want to project your corpus at the age of 50 or at the age of 47 or at the age of 48. You can do what you like. I've put that as 50 there. Now let's move forward. So with that out of the way, those are some of the assumptions that we made. Now let's look at some buffers that if you were to pass away tomorrow, what is it that your family might need immediately, right? What is the buffer that you need? And again, you can be as conservative or as aggressive here as you like. But what I've done is I've taken 1 year salary as your income replacement buffer because your salary is 25 lakhs. I've taken that as a 1 year of income replacement. I've taken 20 lakhs as an additional buffer in case there is some other needs that you might have. It's just general buffer for unforeseen events. You can change this as per how much buffer do you need, but all of this will have impact on how much insurance coverage will you need, and we'll get to that in a minute. So hopefully you're clear so far. These are the yellow fields that you need to input basis your scenario and your life situation. How old are you? When do you want to retire? When is your key financial goal? And so on.
With that, let's move ahead. So now this next section is all of these gray things which are all computed. We'll go through them one by one to make sure that you understand what's going on here. But let's start with the first one. Years until child's college from current age. So your child is how old? Your child is 1 year. Your college is at 18. So that's it. 18 minus 1, 17. Your years to retirement are 15. We've already established that. This is B6 minus B4, which is 45 minus 30, which is your current age. Projected education cost, which is a child's entry to the college. So basically how this has been derived is B25, which is current cost compounded over the next 17 years at a rate of interest of 8%, because that's the inflation that we've taken. So you will need about 3.7 CR. This 1 CR becomes 3.7 CR when your child actually goes to college. Next, inflation adjusted annual expenses at your retirement age. Now, your current annual expenses are at B12, which you've mentioned as 15 lakh rupees. This again has been compounded over the next, you have 15 years to retirement, 44 is 15 years, growing at a rate of interest of 8%, which is the inflation rate that we've taken into account, right? So that's your inflation adjusted annual expenses at the time of your retirement, which is about 47 lakhs. So your 30 lakhs currently becomes about 47 lakhs at the time you retire. And therefore the retirement corpus that you'll need, I've taken an assumption of 25x of your corpus of your annual expenses is what you need. That comes to about how much? 12 crores. So 47 lakhs into 25, that's about this is about 12 crores, right? So that's the retirement corpus at the time of your retirement. Now we also look at savings, because you have been saving all along. It's not like you stopped working, right? So there's a few things that we look at your savings first in row 48, and then we'll also look at your spouse's projected savings over the same period. So accumulated savings at the end of the saving period. Now, this is the formula for a growing annuity. It's a slightly complex concept, so I will say Google it yourself and like understand what this means. But essentially, in a simple terms, this means that your annual savings contribution itself grows over time at 5%, because your annual SIPs are growing at 5% every year. That's what we've assumed. While the money that you're investing is growing at a post-tax rate of interest of 10%. That is what this formula does, and therefore, and this is for your household. This is not just for you, this is for your household. So together, your wife's and your savings currently annually are 35 lakh rupees. So this 35 lakhs growing for the next 15 years, that's the number of years that you're going to be working for, growing annually at 5%, and then this corpus annually keeps growing at 10%, because that's the return you're generating. So that growing annuity comes to about 16 crores. Okay. The second thing I wanted to also compute is spouse alone. So imagine if the person evaluating this was to pass away, spouse's savings annually are 10 lakh rupees. Simple, because they are making 25 lakhs and your annual expense is 15 lakhs. So their savings standalone currently are 10 lakh rupees. The same growing annuity formula when applied for your spouse, they over the next 15 years, I've assumed they also continue to work for 15 years, they will be able to accumulate about 4.6 crores standalone, right? So those are all the input variables, all the computations along the way that we've done. Now let's jump into our two scenarios. Scenario number one, this is the pass away tomorrow scenario. That means that the person evaluating this passes away tomorrow. My recommendation is do not edit these formulas, or don't edit them without understanding them. You don't need to input anything here. This will auto-populate after you have inputted all your entries into the input sheet. So let's start from the top. Total immediate needs at passing. This is 1 crore. How did we arrive at this? This is basically all your current loans plus the buffer that you need, sum of debts and buffer. So if we go back to our loans, how much loan do we have? We have the home loan of about 50 lakh rupees. This is the home loan, this is the personal loan, and then this is 55 lakhs, and then you had looked for a contingency buffer of 45 lakhs. So 55 plus 45 is 1 CR. So that's the 1 CR here. Your immediate lump sum available is the sum of your corpus and the insurance. If you have any existing cover, what do you get there? So that's about 30 lakhs here. And so you're in a deficit. At the time of passing, this person, whoever's evaluating this, is at a deficit of 70 lakh rupees. Target years for funds projection is 17 years. What we've looked at here is the maximum between your retirement or your child's age, whichever comes later. So that's 17 in this case, because you're retiring sooner than that. And then finally, what are your combined future needs? This means that the future value of your, in our case, education, child's education in the retirement corpus that we've taken. So if you look here, we have retirement corpus of 11.8 crores, and child's education that we needed was 3.7 crore. If you add this comes to about 15.59, 15.6 CR. So that's the amount here, 15.6 CR is the sum of those two. That's the first part of what you need. Now, total needs that you pass away tomorrow is the same number here, about 15.5 crores. Next, total assets if you pass away tomorrow. Now, this has two parts to it. It is basically the future value of your current situation, the funds remaining after immediate needs, or the deficit here. There's a deficit here of 70 lakh rupees. This compounds over the next 17 years at a rate of interest of 10%. That's the amount that we've assumed. And therefore, it comes about, that's the first part of this equation, this. And then the second part of the equation is that your spouse has continued to earn these 17 years, right? And so they had made about 4.6 CR here in the next 15 years till they worked. So this 4.6 CR minus about 3.5 CR, which is this money compounded, comes to about 1 CR. That's the amount that you have from an asset standpoint if you were to pass away tomorrow. So you have a shortfall really. B10 minus B11, that's the shortfall here of about 14.5 crores, right? Now, in order to get to this 14.5 crores, 17 years from now, you need to arrive at the present value of today of what that deficit is. And I've done that in the formula here. So you need a cover of 3.8 CR broadly. So that's the answer for you, that no, you're not sufficiently covered and you need a insurance coverage amount of 3.8 CR. Now let's back test this. If you were to copy this amount and we were to go back in this input sheet here and put this here, that your existing term cover, assume you get this tomorrow and you put this here, that you've gotten an insurance coverage of 3.8 CR. What happens here? Yes, now this becomes 0 and yes, you are covered, right? So that's how this works. So that's scenario one. Now if you were to compare this with the thumb rule, the thumb rule typically says 20 20x. Now you are at 25 lakhs. 20x of that would be 5 CR. Given you already have a 30 lakh corpus, you do not really need a 20x. And that's what this calculator sort of shows you, that you need about 16x broadly. Even if you were to get a 4 CR, you get a 16x, and that hopefully helps you save money and make a more informed decision. So that's that. You can change all of these assumptions to make this your own, but hope this helps.
So we've seen one scenario, which is what happens if this person dies tomorrow. Now let's see the other scenario, which is the other extreme, that what happens if this person goes on to live till their last financial goal is met. Are they planned well enough, and how does that projection look? So in this case, scenario 2, live till your final goal is achieved, which is at 47. Because your younger kids' education is 17 years from now, your retirement is actually even sooner. And therefore 30 plus 17 is 47. Current corpus, the 30 lakh rupees that you have today, how does that look 17 years from now, growing at a rate of 10%? It comes to 15 crore rupees. Okay. So that's 15 crore rupees here. Power of compounding, it has grown a lot. However, because you're living and you're working till the age of 45, you're also contributing in the form of SIPs, right? Over the course of these next 15 years from 30 to 45. And so is your spouse. So how does that look? How do those savings multiply? Few assumptions here. This is future value, which means we have taken compounding into effect. The corpus that you have, the investments, the return on investments that you're getting is 10%, is what post-tax you assumed. The annual SIPs are increasing at 5%. Again, these are all assumptions that we made in the input sheet, right? So annual SIPs are increasing at 5%. That means you're saving 5% more than the previous year over the next 15 years. Savings stop after you retire. So you retire at 45 years, your savings stop then. That's what this formula includes. But the corpus continues to keep growing, right? Because you accumulated a big corpus. So that keeps growing. And annual expenses post-retirement, so 2 years in this case, are deducted from your corpus too. That brings us to a number of 19 crores. The formula is here in case any of you want to geek out on it, go for it. But that number comes to about 18.5 crores, right? So the total projected corpus at the age of 47 that you will have is 20 crores, which is the sum of these two. About 1.5 CR from your existing 30 lakhs and 18.5 CR that you're going to save over the next few years. That comes to about 20 crores. Total major financial needs at the above age, which we have calculated already, which is your the sum of this, your retirement corpus and your kids' education is how much? About 16 crore rupees. And therefore you are net positive by about 4.5 crores. All good. You can continue to enjoy life and hope you have a long, healthy life. And it's all good. Last thing, you can also play around with this number. So right now there's, like, I put this as 47 because that's a max duration, but say you to play around with this. You make it 46. What happens if this person dies at 46? Well, 3 crores in the positive. Very good. 44. 70 lakhs. Okay, not bad. 43. Slightly underfunded, right? So again, there's nothing to do with insurance here because the insurance policy will kick in and you will be fine. But I'm just saying that your financial projections, this is more of a financial projection status, that you're potentially slightly underfunded if you stay on till 43, but it's just to play around with, doesn't really have any impact. You should just look at your last goal, financial goal, and how long does that stay on. So if that's still 47, you are excellently covered. It's all good. You have enough money. You will be covered financially. So that brings us to the end of a rather complex video. I understand there's a lot going on in this calculator, and I understand there's a lot missing also, and there might be some errors as well. But that's where I request your support. Take this sheet, make it your own. I think it's a good starting point. It's something I have used personally to finally arrive at whether I'm undercovered or not. Well, fun fact, I am slightly undercovered. I need to buy a little more term insurance. I will do a video on that as well, on which term insurance do I end up buying and the reasons for that. So stick around, consider subscribing to the channel if that's something you're interested in. But with that, we come to the end of the video. Please consider sharing it with your colleagues, with your family members who might be dabbling with the same question on how much term insurance coverage should they get, and they don't want to follow thumb rules. With that, thank you. See you in the next one. And thank you, Ditto, for sponsoring today's video. Go check out Ditto. Link is in the comments. They are amazing for term insurance. You get spam-free, personalized advice without any of their biases. I personally use them and I will use them to buy my term insurance. So yeah, thank you. See you in the next one. Bye.